And that is optimism ahead of today's inflation number. Futures indicating a pretty good rally at the start of trading today, up 130 points on the Dow Industrials, up 33 points on the NASDAQ ahead of the Consumer Price Index report, which is due out in 2 hours' time, 8:30 a.m. Eastern. We will have the number as soon as it hits the tape. Joining us right now is the Chief Investment Strategist for CFRA Research, Sam Stovall. Sam, good to see you. Thank you so much for joining us.
I'm happy to be here.
So we want to get to your dirty dozen, but don't tell us about that yet. Sam has a list of what he's calling the dirty dozen. These are the stocks that got hit the most but will come back fiercely. First, your take on inflation and retail sales. What's most important today in terms of the impact on markets?
Oh, I definitely think it's the inflationary number. Even though the market is expecting the year-on-year percent change to come down versus the prior month, my thought is it might even come down even more than that. So we might see core CPI, instead of being up 1.8% as it was last month, expectations are 1.7. We could see 1.6. So I think we're sort of seeing that kind of optimism built into the futures.
Does that trigger a rally in stocks if we get lower inflation than people thought?
I believe so, yes, because that was one of the contributing factors for this very sharp sell-off, so sharp that it actually took the least amount of time since World War II to cross that 10% decline threshold.
Yeah. So, and Sam, it all started with the wage growth number. So, you know, we've been hearing for years now, wages aren't increasing. It's only the top 1% is the only part that's taking advantage of this market rally. We need wage growth. Then we get the wage growth, and the market had a terrible reaction to it. Sold off, as you say, over 11%, I think, peak to trough. And a lot of that seemed like program trading. You know, we were watching, I've been doing this 22 years, but we were dropping hundreds of points per minute, it seemed like. Do you think program trading or algorithmic trading, computerized trading, is making the entire process that much shorter so we can go through a correction in just a short number of days?
I think that's a very good possibility. I mean, we really were stretched. We were 14% above the 200-day moving average on January 26th. We had gone 564 calendar days, the longest stretch since World War II, without a decline of 5% or more. So once we did get that decline, once we broke below the 50-day moving average, you also had a lot of computerized sell-stop orders kick in, and I think that really contributed to the further spike down.
What's interesting, sort of to Mike's point, when I talk to brokers, retail investors, money managers, their customer base is not freaked out at all, right? So maybe it is just the computers that are driving this behavior, because individual investors, while it's a headline-grabbing story, don't seem terribly concerned. Are you seeing that as well?
Yes, I am. Also, what we're seeing is there's still a lot of money on the sidelines to begin with, a lot of people who just don't trust this overall market. So that adds fuel to the potential rally. And if so many people had been saying, oh, I would love to get some sort of a correction, then this way I could buy back into it. Well, most people were expecting the correction to be 14, 15, 16%. It makes sense then that the market would actually turn around at less than a minus 12% because those want to get back in before everybody else.
So you think that this 2-week sell-off, there was the worst 2 weeks of the markets, or last week was the worst in 2 years, has created some opportunities?
I believe it has, yes. We probably will see some sort of a retest. We normally do. But chances are that the 200-day moving average will hold and present the buying opportunity people are looking for.
Let's talk about the dirty dozen, Sam. Explain dirty dozen to us.
Well, as we like to say in New York, it goes from moist to foist. So basically, the worst performing groups during the market sell-off tend to be the leaders coming out of this. Going back to 1990, which is as far back as S&P has sector and sub-industry level data, basically if you bought the 12 worst performing sub-industries, such as construction materials, such as your construction machinery, life and health insurance, semiconductor equipment. Those were the worst performers in this market decline. But history says if it repeats itself, and there's no guarantee it will, they could more than double the return of the S&P 500 in the coming 6-month period.
So not specific stocks, you're looking at those sectors.
Well, and then from those areas, then I come up with individual stock proxies based on CFRA equity analyst recommendations. So,
and these are 12 stocks. Give us a couple.
Right. So UPS in air freight, looking at Martin Marietta in the construction materials, Caterpillar in construction machinery, Lam Research in semiconductor equipment. So these are stocks that had been beaten up that we still think have good upside potential.
In addition to, or in lieu of buying those individual names, can a retail investor buy those subcategories through an ETF?
There are some of the S&P 500 sub-industry ETFs, but there are 125 in total of the sub-industries, and maybe you have 30 to 35 that are replicated by ETFs. But yes.
Interesting.
So, Sam, just to clarify, looking at Caterpillar, for instance, it had a huge run-up, and then your point is it had a big sell-off when the overall market sold off. It had a bigger sell-off than other names, so that's when you'd want to buy on that sell-off.
That's correct. So a company that had a good fundamental reason to be rising, that still has a buy or a strong buy recommendation by CFRA equity analysts, those are the ones that I'm selecting for that dirty dozen.
You still looking for a good year, 2018?
Good year, but not a great year. I think that you have to look to earnings and inflation. Right now, our expectation is 1.9 is where we end the year in terms of year-on-year core CPI. So that points to about 2,800 on the S&P, or about a 5 to 6 percentage point price raise for the whole year.
What about earnings?
Earnings we see at $155 per share. This comes from the consensus data at S&P Capital
That's
IQ.
18% growth?
So yes, 18.3% is the estimate right now. You're good.
Sorry.
So 18.3% is the estimate right now for the
Yes.
S&P 500 earnings.
That's correct, but stronger for mid-cap and small-cap stocks, which really seem to be lagging right now. I think the worry is with higher rates, what kind of a drag that'll be on their debt levels.
What's that number in terms of earnings growth?
Earnings growth
For small and mid-cap?
Well, based on what I call the rule of 20, would actually, meaning inflation plus earnings, it would actually say that we could see 12% price appreciation for mid caps and 15% appreciation for small caps. So they hold better fundamental outlooks.
Price appreciation or earnings growth?
Price appreciation.
Okay. All right.
So
we'll leave it there. Sam, great to see
low to
you.
mid 20s for the mid and small
Low
cap
to
on
mid
earnings.
20s, so like 23%.
Exactly.
For the small and mid cap. Okay, great. I like to get a good sense of where the earnings story is for the year, because that's the backdrop for the economy.
Absolutely.
And for the market.
Yeah.
Sam,
Sure is.
Good to see you.
Thanks.
Thank you so much. Sam Stovall there. Love that dirty dozen there.